Good afternoon, this is Sean Golding with Golding & Golding, here to discuss a common question we receive regarding foreign pensions, specifically whether a foreign pension is considered a foreign trust for purposes of Form 3520 or 3520A. In general, if taxpayers can avoid doing so, they want to try to avoid filing these forms if they don't have to. Oftentimes it's going to be reported on the FBAR and Form 8938 one way or the other. Sometimes 8621, sometimes the exception will apply. But 3520, 3520A is where it starts to get more complicated. So let's jump into it for a few minutes and talk about the basics. By definition, a foreign pension is a foreign trust, right? You don't think of a foreign pension as like your offshore asset protection trust or 643B or something along those lines, but you have the trustor, the settlor, the creator, and that's going to be the employer. You've got the trustee, which is the administrator of the plan, and then you got the beneficiary, that's the employee. You mix it all in a pot, you shake it up, and that's what you've got in terms of foreign trust. So all the parties are there, even though, again, the goal isn't really to create a foreign trust similar to, let's just say, an offshore asset protection trust in Nevis, right? That's not the point. And for this presentation, we're talking about foreign trusts in particular. So when you're talking about whether to file Form 3520 and 3520A, it's important to determine the type of foreign pension plan that you have. So, for example, if the foreign pension plan was qualified, okay, even though it would be considered a trust, technically, you can avoid filing it for 3520 and 3520A. Internal Revenue Code 402, 404. If it qualifies, then you don't have to file it. Now, most of the time it's not going to. The concept behind it is that if there is let's say there is a U.S. pension plan, qualified plan, that has the makings of a trust and there's some foreign components to it or whatnot, the general rule is you won't have to file 3520, 3520A. Most of the time what you're going to have is a non-qualified employment trust. It doesn't meet the requirements under the particular code section, like your 401k, for example. And so from a baseline perspective, it's going to be reported on these two forms, unless an exception, exclusion, or limitation applies. We'll get to that in a second. And then for non-employment trusts, they're reportable on this form. Even certain foreign pension plans where the employee has contributed more than 50% kind of morphs more into a grantor type trust, and then as a result, it could be reportable for 3520 and 3528 purposes. So what do you do if you're in one of these situations and you have a foreign pension plan, it's not qualified? Do you have to report it on 3520 and 3520A? There's a good chance you won't, so let's talk about that. From a baseline perspective, you're probably going to have to do the FBAR form, bank and financial account reporting. For a quick and dirty summary, you can go to publication 5569 from the IRS and it breaks it down. The examples, one of the examples is the foreign pension plan, right? You're going to have to do Form 8938 specified foreign financial accounts. That includes pensions right there in the instructions. So there's really no way around those two most of the time. And that's typically not that big of a deal for taxpayers. It's an annoyance, of course, right? But it's mainly just maximum value if there's any income associated with it. But it's not anything too intrusive. Now, when it comes to certain types of foreign pension plans, what the IRS says is if it's a tax-deferred retirement trust or a tax-deferred non-retirement savings trust, then you have to do the FBAR and you have to do the 8938. And even though hyper-technically it may be considered a trust from a technical standpoint, you don't have to do the 3520 and the 3520A. And there's lots of different elements that you have to meet, requirements, depending on whether it's a tax-deferred retirement trust, tax-deferred non-retirement savings trust. So you go through the elements and you see what qualifies. Many times it will qualify. High dollar ones with high contribution limits may not. It depends. Now, in terms of where do you look, there's Revenue Procedure 2020-17. Okay, well, let's take a step back. Before that, there was something called Revenue Procedure 2014-55, which is primarily, exclusively for Canadian, SPs, Registered Retirement Savings Plan, RRIFs, where the IRS said, look, yeah, these are going to be trusts, but you don't have to report them for Form 3520. And as time went on in the globalization of the U.S. market, and now there's many people here from all over the world, and many of them have foreign pension plans all over the world, the IRS doesn't have the time nor the resources to create revenue procedures for each country and each type of retirement plan. So 2017 is more like a catch-all, which basically says no matter what country you're from, if you meet these requirements, then it may qualify. And on top of that, in 2024, there were some proposed foreign trust regulations which build upon 2020-17. So chances are, if you have a deferred retirement savings plan or retirement trust, you got a few $100,000 in there, you might be okay. Much higher than that, then you have to look at the different requirements and the elements specifically. For taxpayers who are out of compliance, whether it's 3520, 3528, FBAR, 8938, there's lots of different programs available to help you get into compliance if you're willful. There's a voluntary disclosure program if you're non-willful. There's the streamlined procedures, the delinquency procedures, and reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.